And
I'm recording this.
I hate that announcement too. It's very jarring, but again, I'm Bonnie Walker from Healing Reigns in Bend. I'm the grants and finance manager, and my experience with the 990 is mainly as a grant writer. I kind of tear foundations 990s apart to find out how they really spend their money and where they, what their priorities are versus what the 990 says. So in terms of filling it out for our own organization, I have kind of just let the CPA tell me what to do. And I think people are really busy right now and there's a labor shortage, and the executive director and I both felt like we needed to be a little more proactive with the 990 and not just rely on the CPA to tell us, dictate the list of things and us just go get it. I mean, it worked, but I just felt like we needed to be more involved and more proactive about it. So
thank you, Bonnie. Let's see, Isabel.
I'm Isabel Mora. I'm from Brookings Core Response over in Brookings, Oregon. I am the finance assistant, and I am new to the 990. I do know a little bit. I used to do payroll, so I've done the payroll taxes, but never done these.
Yeah. Thank you, Isabel. Angus.
My name is Angus. I'm the administrative assistant here at Women First Transition and Referral Center. We're located in Gresham, Oregon. And my experience with the 990 has been exclusively this job and exclusively in the context of like, hey, we need to send these people a 990. Like, I've never filled one out before. Most of the time I'm just scanning it and sending it to somebody.
Thank you, Angus. And Crescentia.
Good morning, everyone. My name is Crescencia Witherspoon. I work for Eastern Oregon Center for Independent Living. My office is based out of Pendleton at the moment, but I do have offices in Burns, Ontario, the Dalles, and LeGrand. I am the HIV director, HIV Prevention Harm Reduction Specialist Director. And I don't know too much about 990, but it's important for me to be here and learn, especially when it comes to taking care of our community members. Thank you guys for having me.
Well, thank you very much for being here. So welcome everyone once again. And at this point, I'm going to turn it over to Amanda Green with the, I don't want to guess the name of it again. But you want to tell us about your organization and who you are?
Sure. Thank you so much, Ron. It's really lovely to meet all of you, and I appreciate you coming here to learn. My name is Amanda Green. I'm a CPA, and I'm currently the CFO of Oregon Consumer Justice. I have been working in nonprofit finance for over 15 years now, and I've been in the nonprofit industry for my entire career. I did not become an accountant on purpose. It just sort of happened. And the reason I share that is because there's a lot of gatekeeping to financial information, especially in the nonprofit sector, but in all sectors. And so I think people can come to this kind of information with some trauma or some hesitancy, or people have been made to feel like they don't understand finances. And it's just a personal mission of mine to help break down barriers to access to financial information for organizations and for people as individuals. And so that's one reason I am brought to this work. Oregon Consumer Justice is a relatively new nonprofit. If you haven't heard of us, we've only been around for a few years, and mostly we've been behind the scenes working as a funder. We've recently staffed up and are in a strategic planning process right now and are getting into more programmatic work and partnerships. We are working to bring consumer justice into balance for all organizations, or for all Oregonians. And access to healthcare is a huge, huge consumer justice issue. It's part of our legislative agenda, and that is one of the reasons why we are partnering with the Health Justice Recovery Alliance. In general, we just want people to know we're here. We want people to know about our work, and we're very interested in community partnerships. And so I encourage you to reach out to me or any of my colleagues if you're interested in our organization or working with us. So yeah, that's my introduction in a nutshell. And now I'll just move on to our course overview. But before I do that, I'm interested to learn, is anyone here have a tax status other than a 501c3? Or are we all 501c3s? I'm gonna
501(c).
Okay, thanks. I'm going to assume the silence means we're all 501c3s. Let's see what the chat says. Yep. Thank you. That's good because my presentation is geared to 501c3s. If any of you have like a PAC or a C4 as a partner organization and you have questions about that, I am happy to pepper in information about that. So just let me know. So I will be sharing first a brief history of the 990 and really the nonprofit sector in the US. Then I will be going over a relatively detailed review of the forms and schedules. And then I will be talking about best practices for preparing your annual 990 report and pitfalls to avoid. And then I will also recommend some best practices for working with your CPA partner. And while the sections for best practices are at the end, I will be weaving them in and out of the history as I review the schedules themselves. I posted in the chat at the very beginning links to the forms. I'm mostly going to be concentrating on the full length traditional 990 form, but I also linked to the EZ. And why don't or Ron, would you be able to post those again for the folks that joined late? I don't know if they have the feed from before they were here, just so everybody has those. Thank you. All right. Well, without further ado, let's get into a brief history of the 990. And please feel free to interject with questions as you have them. All right. So nonprofit organizations have been woven into the fabric of American society since our very formation. They popped up as a way to mitigate the inadequacies and inefficiencies of a young government. When we first formed, there wasn't a lot of services that the government provided. And so people got together to create the things that they needed to see in their communities for their communities to thrive. Regulation of the nonprofit industry sprang forth in tandem with income tax laws in the early 20th century. So these are a little bit boring, but I'm going to kind of go through the timeline and then give you a little bit of historical context. So the first law that we see for charitable organizations is in 1894. And that made an income tax exemptions for charitable organizations. So the organizations themselves did not have to pay tax on the revenue or the profit that they earned. In 1909, there was a law that created no private inurement is the technical term. That really just means benefit from nonprofit proceeds. So that means individuals who run nonprofit organizations are not allowed to personally profit from those organizations like a traditional business would. A couple other acts that sprang about is the Revenue Act of 1917. This is a big one that made individual income tax deductions for charitable donations. This is just a key point in nonprofits. That's how a lot of us get our money, is from charitable donations from wealthy folks. And then the Revenue Act of 1936 allowed for corporations to do the same thing. And then in 1943, our first 990 forms were required to be filed. So a couple other things that happened in this time, there was also an act to allow estate and bequests to make charitable donations. So when someone passes away, they can make a charitable contribution from their estate and receive some tax benefits from that. And there was also limits on lobbying activities put on nonprofit organizations during this time. So I want to discuss the historical context. The stock market crash happened in 1929. That ushered in the Great Depression. And then we had World War II from 1939 to 1945. So essentially, the government wanted their slice of the pie, and people were starting to use public charities for nefarious purposes and to hide money so that they would not get taxes. So in general, like, our entire tax code was created right at this time as nonprofit regulation was happening. And so you can kind of see how corporations in particular and the uber wealthy would start using nonprofits to hide that money and have essentially fake charitable purposes that weren't actually doing anybody any good, but were instead just helping the wealthy elites hide money and become wealthier elites during a time when the government and the people were just really struggling in our culture. So America responded by putting these regulations in place, in particular by creating the Form 990. So let me move on here. Okay, give me 1 second. So the form itself originally only had 2 pages, and it was concerned with 2 main things: employee compensation and major donors. And these are 2 very key elements of the 990 today. They wanted to make sure employee compensation was in line with practical amounts of money to be earned and wasn't wild compensation to executives that was out of line with what similar people would make in other contexts. And then major donors, they wanted to know who was giving the money and in what amounts, so that they could track and make sure that people weren't using nonprofits to essentially launder their money. And I just noticed some things in the chat. So sounds oddly familiar. Yes, it does. The nonprofit industrial complex, it's been around for a while. So that's the background and kind of why nonprofits started getting regulated and how the forms came about. So now I'm just going to get into a brief review of the forms. This part is a little bit dry. Just to be honest, we're going to be reviewing government created forms. It's like nobody's favorite thing to do, but it is really helpful. The forms do provide a lot of instruction about what to do and some good detail in there. I did provide the links to the forms in the chat. So if you want to follow along on the forms themselves, I encourage you to. And again, please interject with any questions you have. Okay, so the 990 seems like it's just a bunch of numbers and financial information, but it's so much more. Bonnie, you touched on this like at the beginning of the call, but the 990 shares your organization's story. It tells you so much about what the organization does. And, oh, excuse me, I've lost my notes. It tells so much about what the organization does with its money, what it values, what programs it runs, and what it has to say about itself. And I mean, beyond the just the financial data. It's a chance to educate your donors, market your organization's programs, brag. Honestly, it's a chance to highlight your wins and your successes. And people actually read these. Your funders certainly do. Major donors certainly do. Prospective employees. The first thing I do when I am looking for a job is I look at an organization's 990. I want to know how much the executives are being paid. That helps me get a better understanding of where my salary falls in line. I encourage you to do that. You can also see, like, is your organization walking their talk? Are they actually doing what they say that they're doing in their mission? Partner organizations, look at your 990 journalists if they're trying to do a piece on you or dig up dirt for an article. Just so many people read this document, so it's important to treat it with respect, and also it's important to give it its due and spend some time on the narrative components of it. Be it in addition to the financial components. So there are 5 types of 990s: the 990N electronic postcard, the 990EZ or the short form, the main form that everybody else uses, and then there's the 990 for private foundations, and the 990T, which is for exempt organizations, unrelated business income tax. So I'm only going to get into the first 3. The PF and the T are just very specific forms, and we don't really have enough time to get into those today. So the 990N, also known as the 990 postcard, are for small organizations. Gross receipts less than $50,000. The form is filed online only, and it's only just a few pieces of information. It takes about 5 minutes to file. You have your employer identification number, your tax year, legal name and address, name of principal officer, confirmation that your gross receipts were indeed less than $50,000, and if applicable, a closing statement if the organization is going out of business. Oftentimes during the last year, while you're closing things down, you would have gross receipts less than 50K. So the 990N, if you're a small, kind of less complex organization, might be the last return your organization files. Now we'll move on to the 990EZ, or the short form, as they call it. These are for, again, small organizations, but not tiny ones. Your gross revenue has to be less than $200,000 a year. We also have to have assets less than 500K. So for example, if you're a big foundation, but you don't actually do much in a year, you're not raising money, but you have a lot of money in the bank and endowments or something, you're not going to be able to fill out this short form. You'll still have to do the main form. And so that's why the IRS puts that sort of asset threshold in addition to the revenue threshold for this form, because they don't want essentially large organizations that are inactive, essentially like hiding hiding their money and not having to report the full information that the IRS would like to see. So the 990EZ is 4 pages plus schedules. Many of the schedules that you have to fill out for the 990EZ are the exact same schedules that you have to fill out for the regular 990. So in addition to all the information included on your 990N, your postcard, you also have to include your revenue, your expenses, and your change in net assets, which is also just a fancy term for saying net revenue, or revenue minus expenses equals your change in net assets, your balance sheet, and then your statement of program service accomplishments, a list of key officers, directors, trustees, and employees, and then the itemization of grants received and grants made, if applicable. So now the meat of our presentation is the traditional 990. It's quite a bit larger than the EZ. It's 12 pages plus schedules. It includes all of the information on the 990N and 990EZ, plus additional more detailed information on your finances, on your governance, on policies, on donors, and employee compensation. So the 990 is broken out into 12 sections or parts. The actual form uses Roman numerals to title their parts. I have chosen just to use regular numbers that we're used to seeing to describe the parts or sections of the 990. Okay. So section 1 is just a summary of the 990. It includes prior years, and it's often the only page that people read, so it's imperative that the information is accurate. Section 1 is divided up into a few sections: activities and governance, revenue, expenses, and then net assets or fund balances. The first section is that activities and governance section. The first question in that section is your mission statement or your elevator pitch. You want to make that very savvy, very readable, very communicative and inspiring, because people read it. It's like the first thing on the 990. That's like your exempt purpose. That's what you're doing. So make that statement shine. And definitely don't have any typos in it. I've seen that so many times where organizations have typos in that front and center mission statement. So it just looks bad when people go to read that. This section also includes prior year information if applicable. So you can see, make some inferences about the variances from prior year and the trajectory of the organization. So section 2 is the signature block. Typically, your executive director / CEO or your finance director or CFO will sign the 990. It can be your board president. This information is usually in the bylaws of your organization. You should be pretty clear about who's the signer for your 990 and be consistent about what position in your organization has the ultimate signing authority. If you are using a paid preparer, they must have valid credentials to be able to prepare your 990. They should either be a CPA like myself or an enrolled agent, and they must have a tax preparer identification number. So an EA is an enrolled agent, and it is the highest credential awarded by the IRS, and they are people outside of CPAs that are authorized to be paid to file tax returns. You do not have to have a paid preparer. You can certainly prepare your own tax return. These are just guidelines for if you do pay a preparer to do so for you. Okay, part 3 is the statement of program service accomplishments. I think this might be the most important section of the 990. It's one that I always read. It's a narrative format, but also has financial information. This is your chance to share your mission, your work, and your impact. It's essentially your chance to brag. You need to list any new programs in this section. And you would also list your main programs, the main accomplishments you had in those programs, and then you would accompany that narrative information with financial information as it pertains to that particular program. So if you have program service revenue or earned revenue, restricted revenue for that program, and then all expenses tied to that program. And then if you are a funder or a nonprofit that gives out grants, you would also provide that information. Each program is listed individually. You might have just one. Your organization might have 5 main programs. It really depends on how complex you are. And then the bottom of the report summarizes your total program expense. This is also the first part of the 990 where Schedule O comes up. Schedule O is your supplemental information. It's essentially a form to catch narrative or additional information that supports information provided in the other parts. So if you have more to say than the form allows for space, you can spill over into section O. And I encourage you to do so. Having more narrative rather than less is a good idea when it comes to this form. I also like this section also illuminates why nonprofit financials work the way that they do. The 990 requires that we track our revenue and expenses by function. Those functions are program, fundraising, administrative expense. And this functional revenue and expense reporting is the IRS's way of ensuring that nonprofits are using the bulk of their assets to meet charitable purposes. Okay, part 4 is the checklist of required schedules. This is the section, if you're reading along in the actual form with me, that just has a ton of yes and no questions, 38 yes and no questions to be exact. And this will also direct the filer to complete the appropriate schedules as pertains to the questions asked. So I'm going to go ahead and since we're in part 4, I'm going to review the schedules that accompany the 990 in this section. The first schedule is Schedule A. Pretty much all organizations need to complete these. All 501c3s need to complete a Schedule A. It is the proof that you are a public charity and that you receive public support. So it has a little worksheet in it that lets you calculate the percentage of your revenue that qualifies as public support, and it needs to pass the 10% test. So that means 10% of your revenue needs to come from private foundations or individual donors or government grants. And so if at least 10% of your revenue comes from those sources, you pass. Many nonprofits today have an earned revenue component, especially nonprofits in the healthcare sector. So this is one to really be cognizant of. If your earned revenue, like your fee-for-service type programs, starts to get so large that you don't have 10% of public support anymore, then the IRS will revoke your charitable status. So this is a pretty important schedule to keep on and keep abreast of. So the next schedule is Schedule B. And there's a few questions in section 4 that will let you ascertain whether or not you need to complete the schedule. But essentially it's your schedule of contributors. So anyone that contributes over $5,000 or over 2% of total revenue from a single donor needs to be listed in Schedule B. This includes in-kind gifts, so it's not only cash gifts. You can also increase that dollar amount, so it can be more than 2% or more than $5,000 for larger organizations. If your threshold of public support is more than 33 1/3% of your revenue, and that is as determined by Schedule A. Okay, moving on. The next schedule that Part 4 takes you through is Schedule C, and that's political campaign and lobbying activities. This is a very, very important one. First of all, question 3 in Part 4, if you're a 501c3, should always be no. No, 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 no. Under the Internal Revenue Code, all Section 501c3 organizations are absolutely prohibited from directly or indirectly participating in, intervening in any political campaign on behalf or in opposition to a candidate for elected public office. So you cannot give campaign contributions to a candidate, and you cannot endorse candidates as a 501c3. However, you can lobby for issues and for legislation, and I encourage you to do so. All you have to do is file your H-election, which is a form that you can get on the internet and file online. And then you would need to answer yes to question 4 in Schedule C, and then complete the applicable parts of Schedule C. You can use up to 20% of your total expenditures on lobbying activities. I imagine that all of you, since you're working in the healthcare sector and there's some pretty heavy legislative agendas to regulate healthcare in Oregon, you might actually want to engage in these types of lobbying activities. Totally fine, absolutely okay. You just need to set up a good tracking system, file your H-election, answer yes to number 4 in this section, and complete your Schedule Cs. So next on the list is Schedule D, which is supplemental financial statements. So you need to do a Schedule D probably if you are a large organization with a lot of assets, if you own property, if you are a foundation and you manage donor advised funds. Not if you receive donor advised funds. If you just receive them as gifts, that doesn't mean you have to do a Schedule D. It's if you actually house donor advised funds for donors. Conservation easements for environmental nonprofits, art and museum collections, escrow or custodial accounts for organizations that provide housing. And then if you have an endowment, you would also need to do a Schedule D. I'm just gonna see a question in the chat there. Oh, okay. All right, moving on. So Schedule S is you would only complete if you have operations and activities outside of the US. Schedule G is a popular one. It's supplemental information regarding fundraising or gaming activities. That also includes professional fundraising services. If you hire like a Swain Strategies or someone like that. Fundraising events, if you have an event, you have to complete this schedule. And then gaming, if you have a raffle, a bingo night, a casino night, you would need to complete this schedule. Events are highly scrutinized by the IRS. This just goes back to the corruption in nonprofits that originally spurred the regulation of them. You know, these big wealthy people and corporations would have these, you know, giant Gatsby era affairs in the name of a nonprofit, but they actually would just be throwing a big lavish party to impress their friends. There wasn't much of a charitable purpose to them. And so events are just still highly, highly scrutinized, and for good reason. If you do have an event, it's really important that you're tracking that data meticulously, know how much your overhead is, does part of the ticket cost of an event purchase goods or services. You need to make sure that that doesn't count as a donation. I'll actually get back into that further down in a different section. And also if you're hosting a raffle or a casino night or bingo, you need to get a license from the state of Oregon in order to host those types of events. So just to throw that out there. I'm seeing it in the chat. Let's see if there's a question for me. Because hasn't changed. Okay, let's see. Does this count if there's a, okay, I'll wait and see. Yes, it does count if there's a raffle at a fundraising event. You need to get that, raffle license from the state of Oregon, and your event space will likely ask to see that because they also hold liability if you have that raffle in their space. Yeah, and you would need to report it on this form. And Bonnie is saying they get to go meet Merkley. That sounds fun. You can contact me directly, Bonnie. I'm happy for that. My information's in the slide, and Ron will be sending out the recording and the slides next week. So feel free to reach out. Yeah, thanks, and have fun meeting Merkley. He's a great guy. All right. So, oops, I missed one. The next schedule is Schedule H, and that's only for hospitals. And that's not just medical service providers, that's an actual hospital that has a hospital license granted by the state of Oregon. The next schedule is Schedule I, and that's for organizations who give grants and other assistance to other organizations, to governments, and to individuals inside the US specifically. And then the next form is Schedule J, and this is one that's often required. This accompanies Part 7 of Form 990, which we'll review in just a moment. You must fill out a Schedule J if you pay anyone over $150,000. So if you're a larger nonprofit, if you have turnover of your executives or your board or your key employees, you'll likely have to fill out a Schedule J. And also, if you have a person that works for your organization, but is paid by another organization to work for your organization, you need to complete a Schedule J. And that is common with political organizations to lend staff, and also common if like a funder is giving you staff as funding and not actual money. And let me check the chat here. Does Schedule I cover fiscal sponsorship? You know, that's a really good question, Angus. I don't think so. Because that's a service, an in-kind service, essentially, and not a monetary thing unless there's a money involved. I have actually never
I
really.
I can explain. I can further explain some context for that. So like we are a fiscal sponsor for a smaller organization that does not have a 501c3. And so the grant money for that organization was given to us. We took a portion of it for administration and fees, and then the rest of that money was given to the smaller organization.
So I think this might actually be a Schedule R thing.
Okay.
Because it sounds like when you fiscally sponsor someone, they're somewhat like a subsidiary. You have a more unique relationship with them, and so I think we'll address that in a couple schedules.
Okay.
I'm not 100% positive on that though, so I would have to research that for you to give you a more definitive answer. But I'd be happy to look into that.
Okay, perfect. Thank you.
All right. So moving on. Schedule K is supplemental information on tax exempt bonds. That is if the government has created a bond to fund your organization. That would be, for example, like Regional Arts and Culture Council has a government bond from City of Portland that helps fund their efforts. Sometimes governments provide bonds to nonprofits to purchase buildings for CDCs and things like that. Schedule L is transactions with interested or related parties. So I would say my best practice here is to avoid those altogether. An example here is like a board member would be a related party. Perhaps your board member has a consulting organization, does marketing or is a lawyer, and you need to purchase legal services. You might wind up working with your board member. It's totally done. If you do it, you just need to track it and report it. And it's simpler not to do it. So I will say, like, if you have a board member that is a member of a law firm, but they're not a partner, you could still work with that law firm, work with a different person at the law firm, and not have to report. But if they are an owner in the law firm, or you're working, like money is going to them specifically, you would have to report it. This has some nuance. I mean, related party transactions are not uncommon, but they don't look great from the outside in. And so it's just tread carefully here. That's my advice. Another thing to point out is it's not uncommon to do business with a substantial contributor, which would be another person considered a related party. For example, you have a vendor that you've worked with for years, and that vendor decides to become a major donor or sponsor an event of yours, that will then become a related party transaction. So for example, your bank supports your big fundraiser to the tune of $15,000. You should report that you bank with them. This is a little bit more important for individuals and disregarded entities, which is a single member LLC, than it is for large corporations. It's like more scrutinized if it's an actual person receiving the dollars than a business. And then Schedule M is non-cash contributions. So that would be a report of gifts of art, land, cars, buildings, goods, food for food banks, medical supplies. One of the key things to note about this form, though, is these need to be significant in nature. It would be called material in audit speak, enough to make a difference to the organization. Like if a board member or a donor brings snacks to a meeting to share with your staff, you don't need to report that here. It has to be something that your nonprofit would use as inventory or use in the course of regular business, essentially something that they would purchase if it had not been given to them. Or an investment. Securities, actually stocks, also need to be reported here. If you don't convert them to cash, it is absolutely a best practice to convert any gifted securities to cash. Most organizations have like an Ameritrade or a Schwab account. So when your donors gift you stocks or securities, you can just pop into that account, put a sell order on it, sell it, and then transfer the cash to your bank account. And then you don't have to mess with Schedule M. It's just regular old revenue at that point. So that would be my best practice there to avoid having to complete that schedule. All right, so now the next one here is Schedule N. This is for liquidation, termination, dissolution, or significant disposition of assets. Essentially, you're going out of business, or maybe you are disposing of a program or transferring a program to another nonprofit, is when you would have to complete this. And then Schedule O, we already talked about. That's your supplemental information. You use Schedule O to provide more detailed info and in-depth explanations to other questions as found throughout the Form 990 and 990 EZ. And finally, that brings us to the last schedule we'll review today, and that's Schedule R. And so organizations that use Form 990, this isn't a 990 EZ form, it's only a traditional 990 form, provide information about transactions with related organizations. So this is for partner organizations, for subsidiary organizations, for Angus's example of fiscally sponsored organizations. All of those would be reported on the Schedule R. If you have a PAC or a 501c4 that works alongside your organization, you would also report that here. Also, if you contract out your programs, say you give 80% of your revenue or 80% of your expenses go to pay another organization to run your program, absolutely would be reporting that here. And 80 is an arbitrary number. I would say any large percentage, like probably over 25% of total expense would be reported here. Okay, so that's all the schedules. And now we will move on to the rest of the sections in the 990. And I'm going to kind of breeze through these because a lot of these are numbers, and then we will get to the best practices and questions. So Part 5 is statements regarding other IRS filings and tax requirements. So that would be payroll taxes, your W-3s and your 1096s, unrelated business income tax, UBIT, It has become very popular for 990s, or excuse me, for nonprofits, especially churches, to operate a revenue generating business like a restaurant or a store that is unrelated to their exempt purpose. You can have earned revenue and not have any sort of UBIT. But if that earned revenue has nothing to do with your charitable mission, then you have to treat it like regular business income and you have to pay a tax on it. And then also deductible contributions under Section 170C of the nonprofit code. That question is a yes if you hold fundraising events. The example is one I mentioned earlier. Say you're having a fundraiser and the ticket cost of the tickets to attend that fundraiser pays for the meal, the wine, perhaps the entertainment that's happening at the fundraiser. And so the donor will be receiving an exchange of goods and services for the money they are giving you. You have to deduct the value of those goods and services, the value of the catering, what you're paying, the entertainment, etc., from the tax deductible gift that donor is giving you. So perhaps you set the ticket price at $100, but the event costs $75 per person. Only $25 of that gift is tax deductible. This is something like pretty important to track. And if you were to get audited, which is highly unlikely given the lack of workforce that the IRS has, this is something that they would absolutely audit. So just something important to pay attention to. And that is part 5 and the questions about deductible contributions under Section 170C. All right, part 6. Oh, this is like my favorite section of the 990. This is your government management and disclosure section. This is such a good checklist to go through as an organization, especially if you're new or you've had a lot of turnover or you're growing. It's pretty much just a checklist of best practices on how to run your board, how to create executive compensation, and just key policies to have in place as an organization. I encourage you all to go through this now with your organization. If you answer no to any of the questions, fix it. Now's the time. Make sure you have a whistleblower policy in place. Make sure you have a document retention policy in place. Nonprofit Association of Oregon has templates that you can use all day long. They're really easy to put in place. Do you record and save all of your board meeting minutes? If you don't, do it. Make sure you know where they're saved. Do you have a process for reviewing executive compensation? And really, does your board have a process for reviewing executive compensation? Because that is their duty. And how do you maintain your transparency as an organization? Do you post your 990 on your website? If you don't, you absolutely should.
I have another question, Amanda, about
Sure.
posting 990s on the website. So we use GuideStar. Is
Mhm.
that acceptable as well?
Yeah, GuideStar works.
Okay.
People go there, people know about it. I would just say for like the sake of transparency, it's a good idea to have it on your website in addition to having it on GuideStar.
Yeah, we're in the process of getting our website updated, which is why I'm asking, because it's not on there right now, and we have a guide, like the information is available. It's just not posted on the website right now.
Yeah, I mean, availability fits the letter of the law. But just, yeah, like I said, going a step further is just good to, it's a good practice for organizations to have. Just my personal opinion, I'm a pretty big believer in transparency for publicly supported organizations. And so I go so far as to post financial statements on the website, quarterly reports, things of that nature. I usually overshare instead of undershare. So that's a personal choice for you and your org.
Yeah, I think that's what we're working towards. We're just like right now we're in the process of getting the website finalized. So we want to make sure that everything is, in line with what we need it to be.
Totally. Thank you. So part 7 is compensation. We talked about this a little earlier on when we were discussing Schedule J. This is compensation for your board of directors if they receive a stipend, officers, trustees, key employees, and highly compensated individuals. This also asks if you have compensation practices in line. A key employee is one who has a major decision-making role in your organization. Always your ED. If you have a CFO or a finance director, you should usually include them too. If you have a deputy director or a strategist or someone like that, those are the types of titles that the IRS would like to see here. You provide salary information for the prior year W-2, and that's even if you're not on a calendar year. So if you're on a calendar year, that's fairly straightforward. It's just the salary information from the last calendar year as reportable on the W-2. If you are like a June 30 fiscal, so June 30, 2022, you would be providing 2021 W-2 information on this part of the form. All right, and now we get to the actual financial statements. Part 8 is your statement of revenue. This is pretty much identical to your organization's profit and loss statement, also called your statement of activities, depending on what your organization chooses to call it. Revenue is divided up into the following categories. We have contributions, gifts, grants, and other similar amounts, program service revenue, and then other revenue, which would be like investment income, rents, earned income, and then miscellaneous revenue, which would just be random revenue, small amounts. It would be like returns, you know, things like that. Part 9, statement of functional expense. This is a fundamental element of nonprofit accounting. Like, this statement is why we track things the way we do. It's divided into 3 buckets: program, admin, and fundraising. And expenses from your GL will have to match to the categories on this statement. A little on the 3 buckets. Your nonprofit might have 5 programs, but you would consolidate all of those programs into the program bucket to put in this statement. And then you have admin, management and general expense, and fundraising. There is this sort of rule or benchmark that you've probably heard before. It's called the 70-30 rule. So that means 70% or more of your expenses should be in the program bucket. And then the other remaining 30% should be divided across administration and fundraising. It's usually 20% fundraising, 10% administration. It takes a little bit of accounting magic to get money in these buckets in the right way. The IRS is concerned with averages. Their benchmark is actually 65, so it's a 65-35. If you're dipping under 65% for a program, it will flag you for an audit. That doesn't mean you'll get audited. It's still very unlikely that you will, but they look at that in the context of the span of a 5-year period. And so if you are consistently dipping, under 65% in program expenses, you might have a problem. So this is something to pay attention to. This is absolutely something that your funders and the IRS will look at closely with scrutiny. And this can be fixed with having a robust allocation method for allocating indirect expenses or overhead expenses directly to your programs. And I have a little bit more about that in best practices, but that's honestly, that could be like a whole nother webinar. So number 10 is your balance sheet. And that's just information, your snapshot in time of your assets and liabilities and net assets. And it also shows any restrictions you have, restricted grant income, for example. It shows information on the beginning of the year and the end of the year, and your beginning of the year info should match your prior year return if you have one. This statement, again, is very similar to your organization's internal balance sheet. However, the accounts are different and they're grouped differently. So the accounts internally will have to be mapped and organized to match the form's account categories. And part 11, reconciliation of net assets. This form sounds scary. That's a lot of, accounting jargon there. But honestly, it's just plugging in numbers from other parts of the form and making sure that they add up. There's also a chance here to add an adjustment from prior year. So if and like, as I mentioned in the last slide, if your prior year doesn't match your current year, this is where you'd put that adjustment amount, and then you'd explain about that adjustment in Schedule O. And that's common. Maybe you revised last year's, maybe you caught something after year end that you wanted to fix. It's not going to flag an audit if you're honest about it. If you're not honest about it, it could. So definitely just something to pay attention to. And last but not least, your financial statements and reporting, part 12. 3 questions here. The first question, your answer should be accrual. If your organization tracks things in cash, you are more likely to get audited. It's not generally accepted accounting principles to use cash-based accounting for nonprofits. The IRS does not want to see it. And so I just highly, highly recommend that you use accrual-based accounting for your organization and answer yes to accrual accounting in this section. And then question 2 centers around whether or not your organization subjects itself to an annual audit or financial review by a CPA. If you're a larger organization, for example, if you have over $1 million in annual revenue, you should probably be getting an audit annually. You can also do it every other year just to save some money, but definitely a best practice. And then question 3 pertains to organizations who receive federal funding, and if you have to do a single audit every year. Also a great topic for another call. Okay, so that's the forms. That was a lot to go through. Now let's talk about best practices for preparing to do your annual 990 report. So best practice number 1 is just having your house in order. Have an established accounting system and have strong financial controls. Have an accounting manual, garbage in, garbage out. If you don't have reliable financial data to report on your 990, you will not have a reliable 990 report. So again, use an accrual-based accounting method. Prioritize training your accountants. Someone mentioned, I think it was Brandy before they left at the top of the call, that we have an industry-wide shortage of accountants. It is so true. I'm very happy with where I'm at in my job and my career, but I am hounded on LinkedIn by recruiters because there are not enough people in this field. And so you are very likely going to have to identify someone that has maybe some Excel skills, but probably doesn't have a traditional accounting background, and teach them up. There are some great nonprofits in Oregon who train accountants, and I would partner with them. And perhaps maybe you don't have it in-house. You work with Susan Matlock Jones or one of these other accounting firms to outsource your accounting. It's just so important to not mess this piece up. It just has huge consequences if you don't have your financial house in order, not only with the IRS, but with your donors and funders. So prioritize it. Make sure you have an accounting policy manual and stick to it. And then, can you trust the information in your organization's financial reports? Are they providing meaningful information to you? Also, know where your documentation is. You will need to provide it to your CPA, and you'd need to provide it to the IRS in the instance of an audit. Best practice number 2, have written governance policy and adhere to it. A big portion of the 990 is evaluating your governance practices, and that's your board of directors. Use, again, Form 990 Part 6 as a starting point for evaluating your organization. Go through those questions. If you're answering no to any of those, change that to a yes, fix that. Ensure you have an active whistleblower policy and document retention policy. Revise these periodically to make sure that they comply with legal standards. They get changed from time to time. And then make sure your board understands their role and their fiduciary responsibility. I have this resource here, but the Oregon Attorney General's Office has a guide to nonprofit board service in Oregon. Give that to every board member, do a training with them. It's so, so, so important. If they are not taking their job seriously, if they are not performing their fiduciary responsibility, it could get your organization in serious jeopardy. Question number 3. Understand what you have to report on the 990. Well, you're doing great. You're at this webinar. So this is helping you understand what the forms entail. And then read the actual form. I know it's a lengthy text-driven, inaccessible document, but go through the questionnaires, go through the accompanying instruction manual, and just teach yourself what's happening there. You can also work with your CPA if you have one to go through the form and develop an understanding of it. And then this ties back to best practice number 1, but ensure that your organization is tracking expenses by function and monitoring that your admin and fundraising expenses don't get out of hand. Are you following that 70-20-10 rule? All right, best practice number 4, find a CPA that gets your organization. Find a CPA that works with similar organizations to yours. Ask a partner organization, who do they work with? Maybe you can have their CPA as yours as well. The world of public accounting is vast. Not all CPAs are qualified to do nonprofit returns. In fact, I became a CPA very late in my career, just a couple years ago, recently, and I honestly did not learn much that helped me with my nonprofit skill set. The section about nonprofits is very small. It's focused literally on how to report things according to GAAP on a financial statement. It doesn't have a lot about management and allocated expenses and fund accounting. And so your CPA, unless they've done some continuing education for nonprofits specifically and have worked with nonprofits, like they're just not going to be qualified to do your 990. I have seen organizations have 990s prepared by underqualified CPAs and they reported things incorrectly. So just because someone has this title does not mean that they know what's going on with nonprofits. And also, like, we're such a vast industry. Your education nonprofit is going to be so different from your healthcare nonprofit or your advocacy nonprofit. Their chart of accounts is going to look different. The way they work is going to look different. So really your best bet is to find a CPA who has expertise with similar organizations. All right, best practice number 5. Know your deadlines and start early. So 990 is due on the 15th day of the 5th month following the end of an organization's taxable year. If your fiscal year is on the calendar year, your Form 990 is due May 15th. If your fiscal year ends on June 30th, your Form 990 is done on November 15th. If you have something else, do the math, just know when it's due. Try not to get behind on your organization's financial reports. It's easier said than done, but it can really snowball. And if you're behind on your financial reports, then it's going to be really hard to file your 990 in a timely manner. And a big one, file an extension if you need to. You can get a 6-month extension without any questions asked. You just have to file Form 8868. It's a 1-page form, super easy. Encourage you to do that extension. I have noticed that pretty much all the CPAs I've worked with in my career will just do it automatically, even if you're not going to be late, just to make sure that you're not late. Yes, it's here, I'll just type into the chat. And it's also in the slideshow. Okay, moving on. Best practice number 6, undergo an annual audit or financial review. An annual audit is a great way to prepare for your 990. It'll help you get your financial house in order. Your auditor can be your organization's partner and help you create systems and processes that ensure compliance with GAAP or generally accepted accounting principles. If you are a new organization or if you've had some like financial skeletons in your closet, highly recommend this. If you can't afford an audit or you're just a small organization, have a financial review instead. It's like a mini audit. And it's a great idea to have the auditor or reviewer be the same person that does your 990, because they are the person that understands you best. And you can also do your review or audit every other year, or even every 3 years if it's a huge financial burden to you. I just encourage you to do them in general, even if it's not every year. And there's, do you know TAX, that organization, Technical Assistance, something or other? They actually have a mini grant program that funds audits. And so that could be something to explore if audit is a financial burden for your org. All right. Last but not least, best practices for working with your spreadsheet nerd. Understanding the role of a CPA is a huge one. Your CPA is not trying to bust you. They honestly do not have time. They are, they're your partner. They're not an adversary. If they do find discrepancies or malfunctioning processes in an audit, they can help you fix it by recommending best practices. Our CPA's end goal is just to report accurate information in the correct manner. If they do uncover something illegal or they find gross negligence, we do have the responsibility to report you, or we could lose our licenses, but it's very likely that they would be very upfront about reporting you, walk you through the process of what that looks like and the impacts, and help you work through it. Unless you are doing something like horrible, and then they will probably bounce. But please don't do, anything naughty. If you are working with a CPA on just the 990 and have not engaged them in an audit or review, they have a very limited ability to verify your financial information. They just have a small window into who you are. So if you provide them with bad information or incorrect information or forged information, the risk of that lies with you. That does not lie with the CPA. Your organization is liable for that falsified information. So just know that the CPA, while there is some great risk mitigation to hiring them, they are not going to absolve you of your own risk. So that's just an important thing to know. Understand the role of the organization. What is your role in the 990 prep process? Much of the 990 prep work is done by your organization, usually by whoever fills my role, your accountant, your finance director, your CFO, whatever they're called. They'll need to provide year-end financial statements and schedules that support the numbers in those statements, and other documents like W-2s, 1096 forms, and things of that nature. You also need to provide program information, donor information, grant information, employee and board member compensation information. It's just very important to make sure that key members of your staff are aware of their obligation to get this information to the 990. Full staff includes obviously your executive, your CEO, your money person, oftentimes your development director and your program director. Make sure they know the timeline of when things are due, get them connected, and get them involved. And let me see this checked. Okay. Next, know the process. What does it look like to work with your CPA? So they will provide you with an engagement letter that states the parameters of the service they'll provide, as well as relevant due dates. And then once the engagement begins, your CPA will furnish you with a list of requests and schedules to complete. These schedules and requests will help them get all the information they need to populate the 990. And this is time consuming. It's a lot of information to give them, depending on the size of your organization and the complexity, of course. But there will be a lot of back and forth here. So budget your time appropriately for this, and have that expectation going in. They can't just like pull information out of thin air. It really is a collaborative process with you. After you complete the schedules, they will compile the reports and send them to you for review. And then there will be a review process and then a submit process. Engage your CPA early. This was mentioned earlier, but there are not enough of us in the US to meet current demand. That means all CPAs right now have a very large client load. If you're looking for a recession-proof job, here you go, become a CPA. So if you engage your CPA early, you can make sure to have your 990 filed in a timely manner. It's a good idea to reach out to them periodically throughout the year. Maintain your relationship, keep them apprised of any organizational changes, and sign your engagement letter in advance of your fiscal year end so that you can hit the ground running with your 990 prep. This one's kind of obvious, but open and honest communication with your CPA. Again, it's a partnership. If you're having troubles meeting deadlines or struggling with the request that the CPA has sent, reach out, tell them about it. They can help, they can provide solutions. The list of the requests that they send, while much more accessible than the Form 990, they can be daunting. And so if you are not used to working with financial info or with spreadsheets, they might not be accessible to you. And so ask to be walked through them, ask for guidance, ask if there's a different way you can provide the information. It can be an iterative process. And then don't try to cover up the bad. If you have financial skeletons in your closet, be honest. They can help you present that information in a way that will mitigate risk. Best practice number 6, when you get to the review process, give your 990 a real review. You are the expert on your organization. You know it so much better than your CPA does. You will be much more likely to catch mistakes. One thing to know is the numbers in your 990 will not match perfectly with the numbers in your financial statements. And this is because the information is grouped differently. Sometimes certain information is not included because it's not considered a revenue for the purposes of a 990. So the numbers might not add up, and that could be very confusing. Your CPA creates a reconciliation document that ties the numbers from your statements to the numbers in the 990. Ask to see this document and trace them. Make sure you understand their calculations. Make sure those numbers are in line with your expectations. If they're not, ask them to fix it. Also, going all the way back to the summary information in part 1, make sure that that matches the amounts provided in the subsequent parts of the 990. So if section 7 has like a certain amount for employee compensation, make sure that the corresponding line item on part 1 matches that. And general best practices. Again, the 990 is a public document. It will be read. Have your communications team take a gander at it. Make sure you don't have typos. Make sure that it's easy to read and is persuasive. Embrace that ethos that your 990 is telling you your story. Make it fun. Yeah, it's what oftentimes the only window that people have into who you are. And then post your 990 to your organization's website. Transparency is key. And that, my friends, is the end of my presentation. I would be happy to answer any questions you have.
So if folks have questions for Amanda, now would be a great time. Or any experiences with this process that you'd like to share. One experience I can share is that as a former executive director of a nonprofit, the CPA that we worked with was very they would work in advance. They would give me the timeline well in advance of what they needed and when they needed it. And so having that really strong relationship with the CPA who was informing me early on what was needed and when, and then creating kind of a timeline for getting them what they needed in order to be able to produce the 990 was very helpful to me. And the person that we worked with was somebody who actually had a number of small nonprofit organizations that they worked with, and was very familiar and very comfortable in the social justice environment, because it was like a specialty for them. And so that's an experience that I can share.
Thank you, Ron. Do all of you have a CPA currently, or are any of you shopping? There's this great organization called Asset to the Resistance. It's arpdx.org. They are based here in Portland, but they have just a lot of CPAs that work for social justice issues and specialize in nonprofit. And so if you are in need of a CPA, that's like a great place. Email that listserv, and you might be able to connect with someone that is a good fit for you. And then I'll just drop this URL in the chat.
Well, I want to thank everyone. We don't appear to have any additional questions. I want to thank Crescentia Witherspoon and Isabel Mora and Angus Shumway for coming, and Bonnie for coming today. I want to send our tremendous thanks to Amanda Green for this presentation. It was absolutely wonderful and informative, and we appreciate the quality and the quantity of the information and the timeliness of it. Just a couple things to note, that this a recording is being made of this presentation, and it can be made available to folks as we move forward. And we'll be continuing, the Health Justice Recovery Alliance will be continuing to partner, and the information will be continuing to partner to create additional TA opportunities going forward. And we just want to make sure that folks are aware of that, and we'll continue to move forward and work towards supporting organizations as best we can, as much as we can, for as long as we can. Amanda, do you have any final thoughts or comments?
No, but just that you're welcome to reach out to me if you have any questions, and I really appreciate you all coming today. So thank you.
Thank you, Amanda. Thank you, Ron.
You're welcome. Well, thank you all.
Enjoy your day.
Bye. Happy Friday.